All right, what is going on, you guys? It is Lincoln here, and as promised in the last video, we're going to go over how to sell calls. And I'm going to be talking about covered calls in this video. There are some very outlier cases where you might want to sell a call naked, but for the vast majority of us, it is far better to sell covered calls. And so that's just what I'm going to talk about today. So I'm going to go over a little background on covered calls. Again, this is going to be super short. After that, I'll go over how to actually place the order in TD Ameritrade to open a covered call, and then also how to close it. So stick around if you want to see that. Let me just back up. So in the last video, I showed this graph here. So you can see here, sell calls. We're in this section right here. So we can just read, obligates the seller to sell the stock at the strike price on or before expiration if exercised by the buyer. Okay, so I have bearish in here. It's not perfectly true. I have neutral to bearish here. It could also be slightly bullish if you sell way out of the money. But let's look at this right here. So Microsoft is currently trading at 279.81 as of the screenshot. It is March 11. If we look out 1 week for the March 18 expiration, you can see we can sell the $285 strike for $3.58. So if we own 100 shares or if we own a long call, okay, we can sell this contract, which obligates us to sell 100 shares of Microsoft at $285 in the next week, and we're getting paid $358 to take on that obligation. Okay, so our objective with selling covered calls is to collect premium. We want to collect this $358. What we need is 100 shares or a long call. So if I owned a deep on the money leaps, for example, on this, we could do the same thing and sell covered call. Our max gain is $3.58. If we owned 100 shares right now, say we bought 100 shares at $280, our max gain would be if the share price rose to $284.99 and closed right there on March 18. So our option contract expires worthless, and we also got that $4.99 per share in price appreciation. So technically that's our max gain on the position as a whole, but on this call sell, our max gain is whatever we collect in premium. Our max loss is our cost basis minus the premium. So again, if we bought 100 shares at $280, our max loss is if we lose that full $28,000 that we spent buying those 100 shares, minus that $358 we collected here. So what is that? $27,642 is our max loss. You can see right here, I just laid this out right at the bottom. This contract obligates me to sell 100 shares of Microsoft at $285 per share on or before 3/18 if the call buyer exercises their right to buy. They will exercise their right to buy if the call becomes in the money. So if the share price rises to $285 or above, you can expect this call to be exercised, and you have to sell those 100 shares for $285. If Microsoft goes to $400 per share the next week, too bad, you missed out on that extra $150 in appreciation. You have to sell at $285. If the share price is anywhere below $285 at expiration, that call will be out of the money. It will expire worthless. You'll keep this full $358 and you will still maintain your 100 shares and can repeat the process. If we go to a previous video, I'll link it up in the corner right now to put your stocks to work here. You can see the right way to write covered calls. So I mentioned you want to do this on stocks you already own. With selling covered calls, you should want to own the stock, okay? It's still technically a long position if you're selling out of the money calls. You're just trying to collect a little bit of extra premium. And then point two, select a strike price you're happy to let it go for. So if I'm going to be mad at selling Microsoft for $285 per share, I should pick a higher strike price, okay? I should sell further out of the money. You can see here I said preferably 1 to 3 weeks out. So that kind of depends on what strike price you want. So if you don't want to sell Microsoft for less than $350 per share, if we look at the March 18 expiration and go to the $350 strike, you can see it's paying 2 cents. Okay, so that's obviously not going to work. We should probably go about a month out and then look at that 350. So that's 20 cents. That's a little better. We still might want to go a little bit farther out. We'll go to the May expiration and see what this is looking like. So 87 cents, still not great, but you're also selling 25% out of the money. So that's pretty darn high for 2 months. And if we go back to this one, you can see $285 strike. So we're selling $6 out of the money, which is a few percent, which is pretty tight in this market, but you're also collecting $358. So if I do 358 divided by $28,000, we can get our ROI of 1.3%, but that is in 1 week. So I'm going to multiply that times 52 to give us an annualized return of 66.5%. Obviously, this is a super tight call sell, and we're in a very high volatility market, so that number is a little bit juiced right now. But you can see the power of selling covered calls. Even if you just sell one a month, you can easily make 10 to 15% selling them way out of the money. Okay, I love covered calls. There's almost no reason not to do them if you own shares in your portfolio. That is covered calls, and let's jump to look at what it looks like to sell one of these. Okay, here we are in my TD Ameritrade account, and let's go over how to sell to open a call. So I'm going to sell a covered call on these deep in the money leaps that I have right here. Okay, so on Tattooed Chef. So there's a few ways to do this. I'm going to scroll up, I'm going to hit trade, go to trade. And this is what the basic order screen looks like. Okay, so there's a couple different ways to do this. I'm going to show you using the option chain first, and then I'm going to show you doing it without it. So I'm going to go pick my expiration. We'll go April 14, and I'm going to look at this $20 strike. So I'm going to be selling this, so I'm going to pick the bid. You can see the action automatically switch to sell to open. I'm going to say one contract. It's got that expiration, it's got the strike, and there's the call. You can see the bid, ask, and the last right there. So I'm going to put this in at 0.2 and see if I can get a fill. And there it is. So there's the sell to open. You can see 0.2. It hasn't filled yet, and I don't think it will. So I'm going to show you the other way to do this real quick. So same thing. I'm going to go back to trade, and then instead of using the option chain, I'm just going to fill this all out manually. So same thing. We click sell to open, pick that expiration, and we're going to go to the $20 strike and select a call, and it's going to show the bid and the ask right here for us. So this is the exact same order. I just typed it in all manually instead of going to the option chain. I'm going to go 0.2 and place, and there it is. So you can see the sell to open, and it's waiting to get filled. You can see the status right here is open. This will automatically switch to filled once it does get a fill. Okay, now that we've got it filled, I'm going to show you how to exit this. So we can do it the same way. We can go to the option chain. I didn't actually wait for that order to fill. I'm just going to show you how to close it as if it did. So we sold to open a call. So to exit, we're going to have to buy to close. Okay, so initially when we sold it, we took in a credit. Now we're going to have to pay out a debit. We are looking to pay less than we collected initially. That's how we make money on these. So I'm going to do the same thing, Tattooed Chef. And again, we can do this the exact same way. We can go to the option chain, or we can type it in all manually. I usually go to the option chain, but totally personal preference. So now since we're buying it, we're going to go to the ask. This is going to be a buy to close. And that basically just tells TD Ameritrade, look, we already have this exact contract open in my account. I want to close that one now. So that's what the buy to close. You can see same expiration, same strike. It's the same contract. Okay, and there's the call. Price, we'll just say we want to do it at 0.15. And I would just hit place order. I don't actually have that position open, but that is how I would exit that call. And that's a wrap on the video. I will catch you guys in the next one.